Knowing when to trade and knowing when not to trade is something that most traders struggle with. Even I still struggle with it sometimes. April, guys, was a rough month to trade. And also I really struggled with trading during April, even though I had some of the best trading months prior to April ever in my trading career. But how can we prevent to not get caught in a low probability trading environment? What tips and what tricks can we apply to make sure that we are only trading the high probability trading environment? I will reveal some of the most effective trading techniques to make sure we're trading smarter and not just harder. The first thing you have to realize as a trader is that the price is ranging about 85% of the time. Okay, so only 15% of the time price is trending up or trending down. 85% of the time price is simply trading in a range. Now you guys know that I love to trade ranges, so the first thing you always have to do whenever we look at a chart is to apply and determine the range, because there's always a range to apply and always a range to determine. Now the second thing that you want to do to ensure that you're not getting caught up in fake breakouts and fake breakdowns is that we always try to trade potential deviations or anticipate potential breakouts or breakdowns as long as it is with the trend. Okay, so instead of constantly trying to catch the breakout, constantly trying to catch the breakdown, guys, realize the price is trading in a range 85% of the time. So the actual probability whenever the price is trading in a range and is potentially breaking out, the actual probability of the price actually breaking out to the upside is super low. There's a much higher probability that the price is ranging, right? And eventually we get a breakdown. Everyone is looking to always short this breakdown over here. Instead, we should be anticipating a potential deviation in which we trade the retest and then target the range high and the mid-range over here. That's the first thing that you need to do whenever you analyze a price, all right? Instead of trying to catch the breakouts or trying to catch the breakdowns, try to trade deviations, because you realize as a smart trader that the price is ranging for 85% of the time. And when we trade this deviation, right, when we take, for example, 25% profit at the mid-range and 50% profit at the range high, we can always keep a movement of about 25% of the original position to target a breakout that target higher levels for the price, right? So instead of trying to catch the breakouts, anticipate deviations, trade deviations, and keep movebacks in case the price does actually break out or does actually break down. And by doing this, you're really making sure that you're not getting caught up in these low probability environments, because the low probability environments occur whenever the price is trying to catch a breakout or whenever the price is trying to catch a breakdown. And instead of getting caught up right there, we make sure that as smart traders, we try to trade deviations and target the opposite side of the range. But guys, tip number 2 revolves around actual trending environments, because we know that trending environments usually consist out of 5 waves. We have 3 impulsive waves, either towards the upside or towards the downside, and then we have 2 corrective waves, right? In which over here, for example, for Ethereum, we can see that we are in the middle of a 5-wave impulsive structure. That's something to realize, something to notice, something to know, and we'll make sure that you're not getting caught up once again in these low probability trading environment, is to make sure to notice whenever the price is potentially entering a wave 4. Now you might be wondering, okay, Guru, what is going on with that wave 4? During wave 4, which occurs after the second impulsive wave, which is wave 3, which is the most impulsive wave towards the upside or towards the downside, price enters a corrective stage. Now this corrective stage during wave 4 is a lot different compared to the corrective stage in wave 2, because during wave 4 the price often either forms a triangle, a falling wedge or rising wedge whenever we are in the downtrend, of course, or the price simply starts ranging. Now the second thing which is important to realize whenever we look at a wave 4 is that wave 4 always takes a long ass time to form. So we know that it's going to form a triangle or a falling wedge or a rising wedge, or it's going to start ranging. What do these 3 patterns have common? What they have in common is that they are all very choppy, and market makers do this on purpose, because these waves 4, they are actually designed to chop up as many people as possible before the price enters the last leg of its impulsive structure. Now why is it designed to chop up so many people? Because before wave 4, prior to wave 4, what we see is wave 3, and wave 3 is always the most impulsive structure. Now what happens during this impulsive structure? There's either a lot of people making a whole lot of money over here whenever they catch a trend, or there's a lot of people trying to short, and losing a lot of money. So after this impulse ends and there has been a lot of volatility and a lot of volume, there's people either trying to make back for the losses that they took during wave 4, wave 3 I mean, or there's people that made a whole lot of money during wave 3. And they're trying to compound those profits into even more profit, so they're getting greedy. So what do market makers do? They make a very low probability, a very choppy environment. Either the greedy people or the people that took big losses and want to earn back them losses, they're constantly feeling the urge to be in a position, not realizing the price is actually in a very low probability environment, especially designed to chop off people exactly like that. If we manage to count the waves, and in this case, this is the sub-minute count over here because we are in a bigger 1, 2, 3, 4, 5, and we know that the bigger wave 3 consists out of a 5-wave impulsive structure like we see over here. Now what we can see over here is that if we go to the 4-hourly time frame, what did the price indeed do? What is the price actually doing as we speak while we are in the wave 4 on Ethereum? It is indeed forming a falling wedge pattern. It is not only forming a falling wedge pattern, guys, more importantly, when we look at the volume, what can we see when we look at the volume? The volume is dropping lower and lower and lower, which means that we are in a very low probability trading environment. By making sure that we understand Elliott waves, and I mean especially Elliott waves on a higher time frame, don't use Elliott waves on a lower time frame. We can make sure that we know when we are in a wave 4, so we can make sure that we know when we are in a low probability trading environment. There's a third thing that we can do next to looking at potential fourth waves and next to looking at potential ranges and trading deviations of ranges, is that we also have to look at the open interest whenever we look at Bitcoin and Ethereum. The open interest is something we can find on Coinalyze. I will leave a link in the description down below. You can use this. It's very, very simple. And the open interest is showing to us whether or not there is new money entering the market or not. What we can see over here, if the open interest is coming down while the price is coming down, it means that there's probably long and spot positions taking profit rather than a lot of people selling and short. When the open interest is rising during a move to the downside or during a move towards the upside, it means that the move is being fueled by new money entering the market. And why is this so important? Because guys, if there's no new money entering the market, how is the price going to move impulsively to the upside or impulsively to the downside, right? There's a much higher probability in that case that the price is simply going to continue ranging and going to continue chopping around or starting a new potential impulse. So if the open interest decreasing or the open interest at a very low level, we know that there's not a very high probability trading environment. So as traders, our main job is to preserve our capital, especially if we made a lot of gains or if we made a lot of losses, guys. Those are the kind of moments where we have to preserve our capital. And I know the feeling that we get when we either take a lot of losses or when we take a lot of wins. We want to either earn more or we want to earn back our previously made loss. It's a very human reaction, and that's the part where psychology and where mindset and discipline are coming into play. And that's not the part where this video is all about. This video was about giving you guys 3 tips, 3 tricks you can apply into your trading system to prevent yourself from trading low probability trading environment. If you guys did enjoy today's YouTube video, make sure to smash up the like button, make sure to subscribe to the YouTube channel, and I'll catch you guys on Monday's YouTube video. Ciao, ciao!